On Monday, we did an example where we did both trading securities and available for sale securities, and probably the most difficult thing for you to understand was how to do the mark-to-market adjustment. So I'd like to start today with, on the very back of your handout, there's a page that focuses only on the mark-to-market adjusting entries and leaves out the buying and selling and the dividends and the other things that we talked about. So we can look at how it changes from year to year to year. So as we look at this example, in first year, trading securities could be either stocks or bonds. So far we've only talked about stocks. Next week we'll be talking about investments in bonds as well. So these could be stocks or bonds, but in this example it really doesn't matter because we're looking at the whole portfolio of our investments, whether they're stocks or bonds. So let's say at the end of the first year, our book value or cost was $300, market value was $280. Now hopefully you remember that what we're trying to do is decide how much should be in the market adjustment account at the end of the year. So with market being below book, we need a $20 credit in the market adjustment account. So since market's below book, we have an unrealized loss. So we'll debit unrealized loss and we'll credit the market adjustment account. And since this is our first year, there's no previous balance, so $20 is correct. Now as we move to year two, obviously we've bought and sold some investments in the meantime. Remember, the trading securities by definition should have been sold before the next year. So these would be different trading securities than what we had last year. Book is now $500, market's $493. Market is still lower, but it's only lower by 7. So the market adjustment should have a $7 credit. But what does it have from last year? It's got a $20 credit. So we're going to have to make that market adjustment get smaller. So we're going to debit the market adjustment to make it go from last year's $20 balance to this year's $7 balance. So that's 13. And we'll credit an unrealized gain. Now the unrealized loss or unrealized gain both go on the income statement, and income statement accounts are closed out every year. So each year you can change the name from a gain to a loss or a loss to a gain. The market adjustment account, though, is a balance sheet account. We do not change the name. The following year, December 31st, year 3, book is $650. Different investments because we bought and sold all the ones from last year. Market is now $652. So this is the first time we're now at a debit balance because market is higher than book by $2. So last year we were at a $7 credit. This year we should be at a $2 debit. So we're going to have to make an entry to the market adjustment for $9 because we're going from a negative to a positive. So from a 7 credit to a 2 debit, that's a swing of $9 because we had to go from a 7, which I'll consider negative, we were below book, all the way up to 0, and then $2 beyond that. So it takes a total of $9. And again, if I need a credit, credit would be a gain. Had we needed a debit, the debit would be a loss. So always debit losses, always credit gains with trading securities. Now the following year, book is $200, market's $270. Market is way above book. We finally did a good job of doing some investments, picked some winners here. So we have a $2 debit, but it now needs to be a $70 debit. So the market adjustment is getting bigger on the debit side. So we'll debit market adjustment to make it go from last year's $2 debit balance to this year's $70 debit balance. That would be $68. And since we need a credit, that would be an unrealized gain. And then finally, in year 5, our last year of the example, book was $350. Well, unfortunately, we picked some losers this year. Market's $340. So the market adjustment now should have a $10 credit because market's below book. But what's in the market adjustment? Last year's balance was $70 to the good. Now we're $10 to the bad. So this time, market adjustment's going to have to be on the credit side. And because we're going from last year's $70 debit balance to this year's $10 credit balance, that's a swing of $80. So we need a debit to make the entry balance. And I said a minute ago, if we need debits, that's a loss. If we need credits, that's a gain. So just a kind of a quick review here. In the first year, we were below book value, so therefore we had a loss. In the second year, we're still below book value, but not as bad as we were last year. We're only $7 below, so that's better than we were last year when we were $20 below. So that's why we call that a gain, even though we're still below book value. In the third year, obviously we finally got into the good situation where we're making investments whose value has grown. So obviously that is a gain. And then the fourth year, an even bigger gain because we're now way above book value. And last year, of course, we've dropped in value, so it's a loss. So again, the gain or loss is based upon what's left in the adjusting entry. Figure out what should be in the market adjustment. Compare that with what was in last year's balance, make an entry for the difference. Now that's the trading security. Now available for sale securities, the calculations work basically the same, but the account titles will be slightly different. Again, even with available for sale securities, could be stocks, could be bonds, could be both. So we're assuming this is our whole portfolio of whatever we own. In the first year, book was 300, market's 280, same as up above, so we know that the market adjustment should be a $20 credit. And since this is our first year, we'll have to credit that market adjustment for $20 to get it established. And the debit then would have to be an unrealized loss. Now the following year, you can see in this example, because I'm saying these are long-term investments, my book value stays the same. So these are not new investments like it was up above. These trading securities, you're trading every year. The available for sale securities, you're probably not buying and selling. So it's the same book value throughout this example. So the question is, what becomes with the market values? Going up, going down? So in the second year, book is still 300, market's 294, market is below. So now we need a $6 credit in the market adjustment. But unfortunately, it already had a $20 credit in the account. So to make that credit get smaller, we're going to have to debit the market adjustment to go from last year's balance of 20 to this year's balance of 6. So that's a change of $14. Now here's where it becomes a little bit different. The credit in this case is not to an unrealized gain. The credit stays with unrealized loss. Hopefully you remember the difference we talked about in class on Monday. Unrealized losses and unrealized gains on trading securities up here at the top, those were other revenues and other expenses. Since they go on the income statement, they get closed out every year, so you can change the name every single year. This unrealized loss on available for sale securities, that goes into accumulated other comprehensive income on the balance sheet. So technically, both of these are balance sheet accounts. Therefore, we cannot change the name of either one because we are not closing these accounts out every single year. So we've got to keep the same name. Last year, we were in a loss position, $20 below book. This year, we're still in a loss position. Not quite as bad, but we are still in a loss position. So the balance sheet has to still use the word loss. We're not changing the name because we did not close out those accounts. Now the following year, something different happens. Book is still 300, same old investment we've had for the last 2 years, but finally this company is doing some good things. Their market value has climbed to 309. So the market adjustment should be a $9 debit. Now we know how to handle the market adjustment when it swings from credit to debit or from debit to credit. So we're going from a $6 credit to $9 debit. So I'm going to have to debit the market adjustment. Since we're going from a $6 negative or credit balance to a $9 positive or debit balance, that's a swing of $15. But the credit, this is where it gets a little strange. Because last year, we were in a loss position. Market was below book. 2 years ago, we were in a loss position. Market was below book. But this year, we're in a gain position, so the balance sheet needs to reflect the word gain. But how much of a gain? According to this, it says $9. So we're going to credit unrealized gain for $9. So my plug figure is the unrealized loss that we had last year. Now the unrealized loss has a zero balance. We debited for 20, we credited for 14, we credited for 6, so it's down to zero because we're no longer in a loss position. We're now in a gain position. So the only time we'll use both accounts is if we go from negative to positive or positive to negative. In other words, credit to debit or debit to credit. If we stay on the credit side, you got to use the word loss. If we stay on the debit side, we have to use the word gain. Again, balance sheet accounts do not get closed out. You literally have to take them off the books. So the following year, book is $300, market's $350, so the market adjustment should have a balance of $50 debit. Last year was a $9 debit. So the market adjustment is getting bigger on the debit side. So we'll debit market adjustment to make it go from last year's $9 debit to this year's $50 debit. That's a change of $41. Last year we were in a gain position. We're still in a gain position. Market is higher than book. So we continue to use the word unrealized gain. We are not in a loss position. Last year we ended in a gain position. This year we ended in a gain position. We only needed the one account title. But I made the example where the following year we reversed again. The book is still $300. Market's $298. Market's below book, so we need to be back in the credit side. So we go from a debit to a credit. So we're going to have to credit the market adjustment to make it go from last year's $50 debit balance to this year's $2 credit balance. That's a total of $52. Now last year we were in a gain position, no longer, so you've got to get rid of the unrealized gain. The total amount of unrealized gain that was on last year's balance sheet was 50. The 9 from year 3 and the 41 from year 2. So get rid of all $50. You are now in a $2 loss position. So we're creating this balance sheet account, unrealized loss, which again goes into accumulated other comprehensive income. Hopefully that clears up some of the things we did in our 2 examples on Monday in class. So that deals with cost method. Cost method applies to both trading securities, which are short-term investments, and available for sale securities, which are long-term investments. If you will then pull back out on your handouts, we did this example for Winter Company stock under the cost method where we only owned 4% of their stock. In the bottom half of the page, we want to use the equity method because we're going to buy more than 20% of their stock. Remember the guidelines were 0 to 20%, cost method, passive investment, mark to market at the end of the year. From 20 to 50%, equity method, because you have significant influence. You're a big stockholder. You go to their stockholder meetings. You vote. You talk to the directors and the owners and the managers. You influence. So that's why we call that significant influence over this other company. And we do not normally mark to market. FASB allows us that choice. But if you choose to mark, remember 2 rules. If you choose to mark, gains and losses have to go on the income statement. And that choice has to be made in the year that you first buy this investment, and it cannot be changed later. So if you choose not to mark the first year, then you can never mark to market. If you choose to do the mark to market at the end of the first year, then you have to do it every single year. In our examples in class, we're going to choose never to mark unless we have to. Okay, so in this example, Winter Company had the following balance sheet. Again, like in our previous example on Monday, we see their balance sheet balances. They have $16,000 in assets. They have $16,000 in liabilities and stockholders' equity. So they are in balance. We acquired 150 of the outstanding shares, which means not from Winter Company. We bought those shares on the market from some other stockholder. So we need to know how many shares of stock does Winter Company have. And we see here that they have $10 par, and there's $5,000 in their stock account. They must have 500 shares. That's what was outstanding on the market in the hands of stockholders. We bought those 150 shares from a stockholder, not from Winter Company. So remember, the number of shares did not change. We didn't buy them from Winter Company. So we bought 150 of the 500 shares. So we have significant influence. We're in that 20 to 50 bracket. We have 30% of their stock. So since we're now into that significant influence, totally different methodology. On the two examples we've done so far, both the trading securities and the available for sale securities, we used cost method. Whether they were short-term investments or long-term investments made no difference. It was percentage ownership that determines what method you use, and we owned less than 20%. Now we own more than 20%, so we're going to use the equity method. To help you understand how different it is, I'm no longer going to use the term available for sale security. I'm going to suggest that we call it, when we get above 20%, we'll simply call it investment in whatever company stock that you bought. That'll be a good reminder for us that this is totally different from anything we've looked at so far, from trading securities or available for sale securities. Now, investment in winter company stock is obviously investments in funds. It's a long-term investment. You wouldn't buy 30% of the stock of another company with the intention of selling it very quickly. If you're going to be that big of a stockholder, you're probably in it for the long run. So that's why we're saying that you have significant influence over this company with 30% of their voting shares. But investment in winter company stock, that is still an asset. All assets are originally recorded at cost. So you bought 150 shares, $31 a share. And again, let's put out here, if there were broker fees, we would add broker fees to that total amount. Broker fees should always be capitalized, whether you're buying trading securities, available for sale securities, or bigger percentages that we're going to refer to as these investment accounts. Now that's where the similarities end. As we move to these other transactions, this is where you're going to see equity method is very different from cost method. So it's not because it's a long-term investment, it's because of percentage ownership. The one on the left that we did on Monday, that was less than 20% ownership. We only owned 4%. Now we own 30%. So total different methodology. So let's see what else we did. After buying the stock, it says we received a cash dividend of $1 per share. Well, there is one part that does not change. You received a cash dividend, so that means you received cash. So we are still going to debit cash, and you own 150 shares, and they paid you $1 per share. So the cash is 150. Even if I only own 20 shares, they would pay me $1 per share. Remember that all common stockholders have to be treated the same. You get sued if you treat one group of common stockholders different from another group. They are all common, so everybody got $1 per share no matter how many shares they owned. But the credit, if this was cost method, we call that dividend revenue. It goes on the income statement. This is equity method. In this case, we're going to credit investment in winter company stock. So it is not considered revenue. It does not go on the income statement, and here's why. Who declares the dividends for winter company? Well, that's their board of directors. Who elects the board of directors? The stockholders. Who's the biggest stockholder? We are. So in effect, we have told the board of directors who we elected that we want a dividend. You didn't earn that. You just told them to give you your money back. So when we bought the stock, we said the investment went up and my cash went down. When I tell the board I want my money back, we get the cash back and we reduce the investment. This is not considered a return on investment, as this one is, dividend revenue. That's earnings because it's a return on your investment, over and above. This is considered a return of investment. When I made the investment went up. When they give me some money back, the investment goes down. And we'll talk a little bit more as theory as to why equity method works this way when we get to the next entry. So the third thing that happened this year is Winter reported net income of $2,000, which we said on Monday. That's a pretty good year considering they've only had retained earnings of $6,000. So to earn $2,000 in 1 year, that's a pretty good year for this company. And their stock market value was $34 per share. Now this is equity method. Do we mark to market? And we said we're not required to, so therefore in our class, we're going to assume we do not choose to mark to market. So choose not to mark to market. But net income. Why do you suppose Winter Company was so successful, earning $2,000 in net income on a company that only has $16,000 in assets in total? Well, it's because of your influence. You have significant influence. You went to those stockholder meetings. You told the directors what you wanted them to do, and they listened. You're a successful company. You've helped them to become successful. So their earnings are your earnings. So you have to report that as if you earned part of that. Now, they earned $2,000. That's for their whole company. You obviously don't get all of it because you don't own all of their company. You only own 30% of their company. So you get 30% of their earnings like it was yours. So with the net income, in this case, we do make an entry. Now, under cost method, we don't. But under equity method, where you have significant influence, it's your influence that helped them be so successful. So we're going to debit investment in Winter Company stock. And we're going to credit a new account, investment income. Now they have $2,000 in net income. You don't get all of it. You get 30% of it. So therefore, you get $600. Now, here's where I need to tell you about the other theory that we're trying to apply here. Equity method. Under the equity method, your investment is a reflection of their stockholders' equity. If their equity goes up, your investment goes up. If their equity goes down, your investment goes down. That's why the name equity method. Equity meaning ownership. I have significant ownership in this company. Well, what does a dividend do to their equity? When they declare a dividend, let's see, dividends declared, that's contra retained earnings. So retained earnings went down, that means stockholders' equity went down. So what did you do? On your books, you made the investment go down. Your investment reflects their equity. Then net income. Net income, of course, starts on the income statement, but then net income goes into retained earnings, makes it go up. Retained earnings is part of stockholders' equity, so since their equity went up, your investment goes up as well. So dividends made their investment, their equity go down, made your investment go down. Net income made their investment go up, and it made their retained earnings go up, so that's their equity, so your investment went up as well. Right? But we're not finished. FASB requires that you do a much greater in-depth analysis of what it was that you bought into if you're going to buy more than 20% of their stock. So you may have been wondering in both of these examples why I've given you both book values and market values. When you only buy a few percentage, I don't even care about this. I probably don't know about this. If you buy a large percentage of stock, you're going to investigate what it is you're really buying into. So FASB is going to hold you responsible for any discrepancies that you discovered in this in-depth analysis. So let's look again. When I looked at their company, their cash said that they had $1,000. I probably hired a business valuation analyst, a specialist who does this kind of thing, to go in and do some research for us. He said, yep, they really do have $1,000 in cash. No problem, we agree with what their books say. But when he got to their inventory, their books reflected their historical cost of $5,000. My specialist says their inventory is really in good shape. We think it's worth $5,200. We're going to have to deal with that $200 discrepancy. The third thing we looked at was their equipment. Now their equipment says has a net value. Of course, that means book value. So this is the equipment after subtracting accumulated depreciation. So according to their books, the book value was $10,000. My business valuation analyst, my specialist, says, no, their equipment's kind of worn out. Their equipment's probably only worth $9,400. So we're going to have to account for that discrepancy as well. Then one other thing, looking over here on the other side, on the credit side, on the liabilities and equity, we had to look at their accounts payable, bonds payable, notes payable, any long-term and short-term liabilities they might have. Well, we didn't find any discrepancies over there. Their books said that they had 3,000 accounts payable. My analyst says, yep, I totally agree with that. So we've only got two things that we're going to have to deal with. We're going to have to deal with the merchandise difference, and we're going to have to deal with the equipment difference. Now, this is an analysis that should have been done back in January when we bought the company. Now, we don't have to account for those differences until the end of the year. Now, I'll explain why. We first of all need to set up a little chart. Now, with your little page, probably the best place I can put it is up here at the top of the page. I would normally write this on the board in class, but since I'm doing this with video, we'll try to put it on the screen here. We want to compare the price you paid for the company. Now, the price you paid is right here. You paid $4,650. You bought 150 shares at 31, so that's the price you paid. Now, we want to then see what that will equal, what it justifies. Why did you pay $4,650? Well, we're going to start with something called book value of the company. Now, sometimes in financial management, Mr. Wiley will talk about book value of a company. So some of you finance majors may be more familiar with this than the accounting majors. Book value of equipment means equipment minus its accumulated depreciation. Book value of a whole company means the assets minus the liabilities. What's another name for assets minus liabilities? Well, that's stockholders' equity. So we could either say it's 16,000 minus the 3,000, which would give us 13,000, or you could simply add up the common stock, the paid-in capital, retained earnings. Either way, we would get book value of the company was $13,000. That's always our starting point. You would have looked at their books to at least get some idea what you think the company was worth. But you didn't buy the whole company. You only bought 30% of the company. So that would have been $3,900. But you paid $4,650. According to their books, you should have only paid $3,900. There's some explaining that we've got to do. Now we're ready to look at some of those discrepancies, because those discrepancies are part of the reason we were willing to pay an extra price. So let's look back at those discrepancies we found. First of all, in merchandise, according to their books, was worth $5,000, but my analyst says it's worth more than that. So we need to increase their merchandise inventory by $200. But just like with book value, you didn't buy all of it, you bought 30% of it. Well, that helps me a little bit. $3,900 for the books, $60 for what I found out the books were not accurate. The real value was $60 higher for what I paid. And I've got some more explaining to do, so let's go on. Next, we knew there was a discrepancy in equipment. There's a $600 difference here in equipment, but the equipment needs to be decreased in value, not increased in value. So we're going to decrease the value of the equipment by $600, but just like the first two pieces, times 30%, that's $180, but now we're going on the minus side. We decreased the value of an asset instead of increasing the value. So that should have been a reason that we paid less for this company instead of a reason for paying more. So let's see where we are. I paid $4,650, and so far, $3,900 plus 60 would be $3,960, minus $180, we're at $3,780 compared to $4,650. So we need another $870 to make this balance. We're that far out of balance. Well, let's look back. Was there any other discrepancies? Cash? No. Accounts payable? No. So what do you call it if you pay more for a company than the market value of those companies' assets and liabilities? Now, that was about 5 weeks ago. And remember back in the intangible asset chapter, if you pay more for a company than it's worth, we call that balancing figure Goodwill. So this company must have some goodwill. They must be in a good location. They must have a good reputation. There's something about this company that caused you to be willing to pay an extra $870 and it wasn't something we could see, feel, or touch. That's what Goodwill is. Remember, we called that the unidentifiable intangible asset. It has no physical existence whatsoever, but there's something about this company that makes it better than its competitors, and you're willing to buy into that successful company history. All right, so we've got potentially 3 problems to deal with. We've got the merchandise inventory, which our share of it is $60. We've got the equipment, which our share of the equipment problem is $180. And we've got the Goodwill, which our share of the Goodwill is $870. Now, there is some good news here. The whole idea of these differences is to make adjustments as these differences affect net income. So when does merchandise inventory affect net income? Well, when you sell it. Well, have they sold it this year? When you look at the problem, it says this company was using first in, first out. So the inventory they had on January the 1st, where is it by the end of the year? Well, if they're any sort of company that's turning over their products, it should have been sold somewhere during the year. How much of it? Well, I would hope all of it. Now, the problem might tell you only half of it's been sold, only a third of it's been sold, but typically speaking, we would assume that all the inventory would have been sold in the first year. So all of that $200 discrepancy has now been sold. It's no longer a problem with this company's books, but we're going to have to account for it. When does equipment affect net income? Well, I don't think they're selling the equipment, but the equipment has a 5-year life, so it has to be depreciated. So as they depreciate the equipment, we're going to have to account for this $600 difference through the depreciation differences. And then finally, the Goodwill. When does Goodwill affect net income? Do you remember? Do we amortize Goodwill? No. Amortizing Goodwill is kind of like depreciating land. There are certain fixed assets we don't depreciate. There are certain intangible assets we do not amortize. So we do not amortize Goodwill. Do we have to test it for impairment? We learned about that a few weeks ago. FASB says under equity method, I don't even have to worry about testing their Goodwill for impairment. Because this is not my Goodwill. This is Goodwill I bought into from Winter Company. They've done some successful things that made the company more valuable than the things I can see, feel, and touch. So we don't have to mess with the 870 at all. So we know that the Goodwill exists, but we don't have to deal with it. All right, so the only things that we have to deal with is the $60 adjustment to merchandise and the $180 adjustment to equipment. Now, with the $60 adjustment to merchandise, we said we need to increase merchandise, but we also assumed, since they're using FIFO, they sold the merchandise. So it's no longer in merchandise, it's now in cost of goods sold. So we're really needing to increase their cost of goods sold. Well, if you increase their cost of goods sold, what would that do to their net income? That would decrease their net income. And if you decrease their net income, what entry do you make on your books? Well, let's look at the entry you made on your books to record their net income. You debited the investment and you credited investment income when they had net income. But now you're saying, oh, that net income's not right. That net income was too high. So how do we fix it? Our only 2 accounts are right here. Even though it really does involve their cost of goods sold, well, it's not my cost of goods sold, so I cannot call it cost of goods sold. The only 2 accounts we're allowed to use is investment in winter and investment income. And those 2 accounts either get bigger or smaller because of these discrepancies that we found in our analysis. So since increasing merchandise made cost of goods sold go up, which makes net income go down, we're going to debit investment income, and we're going to credit investment in Winter Company stock. Now, our share of the problem was $60. So there was a $200 discrepancy, but our share was 30% of that. And we're assuming that they sold all $60. Now, if they said that they sold half of it, then we'd make this entry for half. They said that they sold 80% of it, we'd make this entry for 80%. But we'll always assume if it's merchandise that they sell it all in the first year. Second, the equipment. We think we need to decrease the value of their equipment. Again, let's look back at the problem. The problem said, according to their books, the equipment was worth $10,000, But we said it's really only worth $9,400. So when they started depreciating that equipment, they said it's $10,000 over 5 years. We don't agree with that. We think it's $9,400 over 5 years. Well, obviously then, since they've got a greater value in equipment, they're also going to have a greater amount of depreciation expense than what we believe is truly accurate. So we're going to have to decrease depreciation expense. And if you decrease an expense, that's going to increase net income. So it's their net income that's wrong because of their depreciation being based upon their book value. But I don't agree with their book value, and FASB holds me responsible for what we know to be the truth. And what we know to be the truth is that equipment was really only worth $9,400 when I bought this company. So they're taking too much depreciation. So to fix it, we need to decrease their depreciation expense, which will increase their net income. So the only two accounts we're allowed to use, remember, is investment in winter company stock and investment income. They either get bigger or they get smaller. So since this adjustment makes net income go up, it's going to make both of those accounts go up. So we'll debit investment in winter company stock, and we will credit investment income. Now, we said the equipment affects net income because of depreciation. Our share of the difference was $180. But not all $180 affects this year's net income because this equipment had a life of 5 years. So it's going to affect net income over the 5-year life. Now, in this chapter, we'll assume straight line depreciation, just like we did in the lease chapter. So we'll just take that $180 and divide it by 5 years, and we'll get $36 per year. So we're actually making 3 entries here at the end of the year. One to record net income, and these next 2, let's call those adjustments to net income for those things that we found out in our analysis when we bought them, where book value was not equal to market value. All right, that's our first year. A lot of differences you can see between what we did under the cost method, where it was less than 20% ownership, versus the equity method, where it's more than 20% ownership. So yes, we do record cash dividends, but don't use the same account titles. We do not mark to market where we did under the available for sale security. We do record net income, and that's not the end of it. We've still got to adjust that net income as well. All right, so we move forward into the next year. What happened in the next year? Well, somewhere during year 6, we received a 10% stock dividend when the stock market value was $32.50 per share. Now again, this is pretty much the same example we did on Monday. We received a stock dividend. Now, under the cost method, we said since there was no cost, we made no entry. What about under the equity method? Let's remind ourselves. Under the equity method, our investment is a reflection of their equity. If their equity goes up, my investment goes up. If their equity goes down, my investment goes down. What does a stock dividend do to their equity? Well, all dividends reduce retained earnings because it's dividends declared, which is contra retained earnings. We saw that in our very first page of the handout. Dividends declared take away from retained earnings. So whether it's a cash dividend declared or a stock dividend declared, they take away from retained earnings. So what's the other half of the entry on a stock dividend? The dividend declared makes retained earnings go down, but they're going to give out stock. So therefore, their common stock and their paid-in capital are going up. Retained earnings went down, common stock and paid-in capital go up. End result, no change in their equity. So since their equity does not change, our investment does not change. So again, no entry when we receive a stock dividend. But we might want to remind ourselves that we received 10% times the 150 shares, so we got 15 new shares for free. So here's the rule. When you receive a stock dividend, you never ever make an entry. Whether it's cost method, whether it's equity method, whether it's a trading security, whether it's available for sale. You never make an entry when you receive a stock dividend. Now, in a few weeks from now, we'll talk about when you're on the declaring side. What if you were Winter Company? There is an entry to declare it, but not to receive stock dividends. Okay, next question. With this extra 10% dividend, what percentage of the company do you now own? Before the dividend, you own 30% of the company. But now after the stock dividend, what percentage do you own? Still 30? Or 10% of 30, 3% more? Do you now own 33%? Remember what we talked about over here with the outstanding shares? We said that it did not change their stock because we bought it from stockholders. This time, who gave you the stock dividend? Was it coming from another stockholder? No. The stock dividend did come from Winter Company. So Winter Company's common stock and paid-in capital have gone up. So do you own 30%? 33%. Well, let's think about this. Originally, you owned 150 shares. You now receive 15 more. Originally, there was 500 shares. Who got the 10% stock dividend? Just you? No, we talked about that earlier. They can't single you out. Every stockholder got a 10% dividend. So the fact that you owned 150 shares gave you 15 more. The guy who owns 20 shares gets 2 more. The guy who owns 30 shares gets 3 more. Everybody got a stock dividend. So where there used to be 500 shares, they gave out 10% more. That's 50 more shares. So yes, you own more shares. You now own 165, but there's more shares in total. There's 550, which, by the way, still 30%. So technically, you're no better off, you're no worse off after the stock dividend than you were before. So what's the value of the stock dividend? Nothing today. But in the years to come, those extra shares of stock will collect extra cash dividends, and those extra shares of stock continue to grow in value if you ever decide to sell it. That's where you'll see the value of getting that stock dividend. Not today, but in the future as the company continues to prosper. Okay, let's finish up at least year 6 and we'll call it a day. December 31st, year 6. Winter reported net income of $3,000. That was even better than last year. Stock market value, let's use the same number we used up above. Up above in our example at the end of year 6, we said it was 35. So let's go ahead and put in 35. But hopefully you remember we can really put in any number we want because this is equity method. Do we mark to market? No, we don't mark to market. So whatever that was, 35, 32, 18, wouldn't make any difference. We're not going to adjust that because we chose last year not to mark to market. And once you make that choice, you can't choose to do the opposite. So let's go back here and say, okay, we choose not to mark to market. So that is a permanent choice on this investment. Now hopefully you also remember from our discussion in bonds, FASB does allow this for every new investment. So if you go buy Summer Company as opposed to Winter Company, and you want to buy 30% of their stock and you want to choose to mark on Summer Company, that's perfectly fine. Still don't agree with that theology because that allows us for inconsistencies. The FASB does allow you to choose that for every single long-term investment, but it has to be chosen in the first year you buy the stock. So with Winter Company, we've chosen not to market. We're stuck with that forever, no matter what happens to the market value. So we know that we do not mark to market. So I'm going to put a little X there, no entry there. But the net income. Well, again, FASB does require consistency. So if you're recording the same thing year after year, it ought to be recorded the same way. So how did we record it last year? We debited investment in winter. We credited investment income. So we're going to do the same thing again this year. At least the same account titles. So debit investment in Winter Company stock. And credit investment income. And we'll use the same theory as last year, just not the same numbers. We've already talked about that we still own exactly 30%. Even after the stock dividend, we still own 30%. So we get 30% of their net income, but here's the difference. This year's net income was $3,000 compared to last year's $2,000. So we get 30% of $3,000, which would be $900. So last year we only got $600, this year we get $900. Same theory, just different numbers. Now last year we made two adjusting entries, one to adjust net income for merchandise, one to adjust net income for equipment. So let's put over here, adjust net income. Adjust net income. Let's put a reminder on here. The first one was for merchandise, and the second one was for equipment. I'm going to go back to last year and do the same thing. The first one was for merchandise, the second one was for equipment. All right. Now last year for the merchandise, we said debit investment income, credit investment in winter company stock. We're going to do that again this year? No. Here's where the break comes in. We made the adjustment for all $60 last year. Merchandise is a current asset, which by definition means its life is 1 year or less. So that's a 1 year adjustment. You don't have to do it year after year after year. You do it one time and then you're done with it. So we don't have to adjust for the merchandise again. Now the equipment. Last year we said debit investment in winter company stock, credit investment income. Do we have to do that again? Yeah, because equipment had a 5-year life, and this is only the second year. Now, assuming straight line depreciation, not only will it be the same amounts, it'll be the same accounts. So there we see that consistency. So we'll debit investment in winter company stock and credit investment income. For the same $36 we did last year. It looks like my time is up. So our next homework assignment, which would theoretically be due on Monday, is just a little beyond what we've done today, because our next homework assignment deals with investments in bonds. So that problem will not be due until Wednesday of next week instead of Monday. So over the Easter weekend, you do not have any homework to be done. Thank you.